Here's the truth about gold as an investment. I think it's a bad investment. It obviously doesn't have very high returns long term, but that's a given. The problem with gold is that the unique selling point of it protecting wealth over the very long term is also flawed in my opinion. And the reason for that is its high volatility relative to the rest of the market. So what I like to do is I like to look at asset classes and relative valuations to one another. So instead of looking at the US dollar charts, what makes more sense is how is one asset class actually doing relative to another. For example, here, gold versus the S&P 500. That's this chart, what we see over here. It's gold denominated in the S&P 500, the gold price divided by the S&P 500. And this chart is very, very, very long term. This starts in 1909. This is a chart that's more than 100 years in length. So any of those rallies that we see here, or any of those bear markets, they pretty much last almost a generation. Right? It's really, really long-term moves that we see here. So when we look at the bottom, right? The bottom at the end of the 1970s. And we look at the top here at the beginning of the 1980s, 12 years. Gold during that time rallied by 1,500%, right, in relative valuation to stocks. So everybody got really, really excited about gold. And the reason for that was the abandoning of the Bretton Woods system. So at this point in time, it was not possible anymore to convert your US dollars into gold, right? The pegging had been broken, and this happened in August of 1971. This is what this vertical line here stands for. So there was a lot of excitement around gold simply because gold was then be seen as the harder of the monies. And this is where then everybody rushed into gold. But this has then turned around massively. If you thought, okay, I rather park now all my money in gold and I forget fiat altogether, I forget stocks altogether, and you came a bit late to the party, right? You started at the beginning of the 1980s. And instead of buying stocks, you would have followed the crowd and simply bought gold. Had you done this, you would have underperformed stocks by roughly 97%. So had you bought stocks instead of gold at the beginning of the 1980s, you would have roughly 30 times more money after 20 years. That's what kind of an impact this has, right? This is why going sometimes contrarian does make sense if you have a fundamental reason for this. But of course, you need to time this right. And so this is what I mean by volatility within gold, right? If you don't time this right, if you just blindlessly allocate, right, then for 20 years, you can have pretty much your entire gold position become worthless to your other relatively liquid position, being stocks. I'm sure I don't have this chart prepared, but I'm sure we will see similar kinds of volatility if you compare this, for example, to real estate prices. So that's the message here. You do want to still try to allocate your positions based on where you think the market is heading. So of course you don't want to go 100% into stocks. You don't want to go 100% into gold. That's a no-brainer. But you still don't just want to blindly allocate, say, 5% of your money into gold if you do think gold is on a bad trajectory, right? Because you're still going to lose massively. You do want to shift this around, and you do want to rather over-allocate to something that you think is comparatively cheap at a time and under-allocate where you think something is comparatively expensive. For example, right now, right, in the current situation, property is still comparatively high, right? It is coming down, but it's still on a relatively high level. Bitcoin, for example, is very, very low right now, right? It has already come down 70%. But this kind of a drawdown hasn't yet impacted all markets just yet. So at the current point in time, right, no financial advice, right, but it would make sense using that logic to rather take some risk of property. If you have, say, a lot of properties rented out, not a lot of people have this, right, but let's say you've got some REITs running that haven't yet come down. might make sense to take some of that capital and put this into something that's already depressed, where you do believe that the assets might recover in the future, right? In like 5 or 10 years from now. That's always what you want to do for long-term investments, right? You only want to buy something that you're long-term convicted of, that will stay around and will eventually recover. That's simply just short-term price depressed. So this is what we're looking at. We then saw a reversal again, right? So this was in the dot-com bubble burst, okay? End of the 1990s, so beginning of 2000. This is when the dot-com bubble burst, and this is when people wanted to get risk off again, and that's why they bought gold again. And this is then where it rallied again by a 7x. So how can we time this? It looks like there are these very long-term cycles of several years where gold is underperforming or where gold is outperforming, simply these bull and bear markets, and they seem to be somewhat predictable, right? There is not too much volatility in those trends. What we could do, this is of course not scientific at all, right? But what we're looking here at is the monthly chart. So we could go with a monthly moving average. So let me draw here a moving average, and then we can maybe adjust the length of that moving average. Let's maybe take a 60-month moving average. That's now a 5-year moving average, basically, right? 60 months. This is that line over here. And you could take this as a rough guide to where gold is currently at. Right? Is it currently rather in an appreciating trend or in a depreciating trend? Now we still see our fake outs here, right? We see a fake out here, we see a fake out here. And maybe you don't want to reallocate that often, especially when we have the sideways movement. Maybe let's increase this a little bit further to also reduce this fake out, get rid of that one. So 72 months, right? 6 years. This seems to eliminate most of the fake outs. And if we look at this, we would have been long stocks at roughly 80, 82. We would then be long gold around the 2002, right? We would have still gotten an appreciation of 250%, relatively speaking. And now we are pretty much at the crossroads. We did see a bit of a fake out here. But let's see where this goes, right? Let's see if gold can continue to appreciate relative to stocks, maybe another 20% or so. Maybe it's then again time to allocate a bit more. What's important is to somewhat ride these waves, because gold is definitely, in my opinion, simply due to its relative value volatility, not an asset that you simply just put in your portfolio and forget, like most people think. Gold is definitely not a vehicle that keeps your purchasing power over the long term. At least if you don't expect long term to be, say, how long does this go from one bottom to the next? This is 400 months. Okay, 400 months divided by 12, 33 years. Okay, one generation. Let's look here from top to top. Also 366 divided by 12. So one of those cycles is roughly 30 years. So if your definition of long term is 30 years, then of course you could just put it in a portfolio and forget about it. Most people don't have this kind of a time horizon, right? It would mean you buy something at the beginning of your work career and you sell something at the end of your work career somewhat. And this is where you somehow cancel out the cycles, right? 30 years, it takes 30 years for one cycle. This is where you can somehow cancel this out, no matter where in the cycle you buy it. But if your time horizon is just a little bit shorter, and you might need the money a bit earlier than 30 years, and you can't just wait for a whole cycle to complete, then it does make sense to ride these waves somewhat and to try to time this. Currently, we are a bit at a potential crossroad, but still, right, we are pretty much bearish on gold since 2013, roughly, according to this model, according to this kind of indicator. So that's what I simply want to share here, right? Still try to time the market somewhat. Don't go overboard with this, right? Don't go 100% in any asset class. Don't invest everything in property or in Bitcoin or in any crazy altcoin or in gold. Of course, diversify, but don't just blindly diversify. Still try to adjust the weightings of each of your positions based on where you think a certain asset is headed. Even though you might be wrong, right? You're still at least diversified. That's fine. I still think it makes sense to somewhat at least attempt timing this. There's not too much harm in this because you're somewhat protected anyways. And one way to time this is to look at these relative valuation charts. If you're wondering how to actually pull this up, right? If you want to look at similar charts yourselves, you go to tradingview.com. So link is in the video description of TradingView. This is actually an affiliate link. So if you want to sign up for the paid version, but you can also look at this with the free version. And you simply just start typing on the keyboard. So I'm starting typing now GEOLD for gold. And then in order to get the relative valuation, you put in the /, you divide the price by something else. And the ticker symbol for the S&P 500 is SPX. That's all that you do, right? You enter this, you press enter, and then you get this chart. Right? In order to get this very long-term chart, you potentially have to increase the tick size. You don't want to look at the daily chart because then it stops rendering after a while, I think. Simply, if you want to see everything on one single chart, you have to have longer tick sizes for longer durations. So that's how you do this. In general, I like these charts quite a bit. You find a lot of interesting insights here, right? For example, this is the S&P 500 relative to the NASDAQ, or the other way around, right? The NASDAQ to the S&P 500. So we see that technology stocks tend to outperform regular stocks over the long term, with recently somewhat of a dip because of the interest rate hikes. These are the kinds of charts that I think are pretty useful. You can also do this with individual assets, as we very often do on this channel, right? We very often look at cryptocurrencies relative to Ethereum, for example, or relative to Bitcoin to see their outperformance or underperformance over the long term. You can also do this with stocks and, of course, with indices. And this is simply a useful tool, right, to time cycles. And currently gold is rather bearish, somewhat at the brink. Let's see where it goes in the next months. Still, try to time it. Don't just passively have it in a portfolio and never look at it. It's not going to protect your purchasing power that well. If it has the potential to go down by 97% in 20 years, that's still very volatile. If you found this useful, please give this a thumbs up. Feel free to subscribe as well. I publish videos here regularly. Feel free to also check out the Telegram groups there in the video description as well. See you in the next video. Bye-bye.